Welcome to the Deep Dive. Today we're getting into the recent news around Spandana Sphoorty's rights issue. We want to cut through the noise and really understand what this financial move means.
Yeah, this one's interesting. It's a really clear example, actually, of a company using this specific mechanism, a rights issue, to handle some serious financial headwinds. We can break down what it implies for investors, for the market.
Okay, let's unpack it then. Spandana Sphoorty, small cap microfinance. So, first off, what exactly is a rights issue? What's the basic idea?
Right. So at its heart, it's a way for a company to raise new money, new capital, by basically giving its existing shareholders the first chance to buy new shares.
Like an inside track.
Exactly. And often they get these shares at a better price, more attractive than what they're trading at on the market. It's like a special invitation for current owners.
Got it. So for Spandana Sphoorty, they're aiming for 400 crore rupees. Now, a crore is 10 million, so that's around 48 million US dollars. That feels pretty significant.
It is significant, and it's aimed squarely at strengthening their financial position, but it's important to see it as just one piece.
Oh, part of something bigger.
Yeah, it's part of a larger plan to raise up to 750 crore rupees in equity within this fiscal year, FY26. So this 400 crore is just the first tranche, really. It definitely signals a substantial need for cash infusion.
And this wasn't just decided overnight, I assume?
No. The board of directors gave it the formal green light back on July 15th, 2025.
Okay. And how many shares are actually being offered? You mentioned something about them being partly paid up. What's that about?
Right. So they're offering 1,073,091,304 of these equity shares. And yes, partly paid up. It basically means shareholders only pay a fraction of the price up front.
Oh.
The rest is due later in one or maybe more future installments or calls as the company decides. It spreads out the cost for investors, but it also means you're on the hook for future payments.
Right, a future liability.
Yeah.
So with this big capital raise, they need to make it tempting. What's the actual price per share? Is there a decent discount?
Yeah, they've set the issue price at 230 rupees per share. And the incentive is pretty clear. It's about a 25% discount compared to the recent market price.
Okay.
The last closing price on the BSE, the Bombay Stock Exchange, was 306.30 rupees. So yeah, that discount is definitely designed to make existing shareholders want to jump in. It's a pretty common tactic.
Makes sense. Now, with these kinds of issues, timing is everything. What are the absolute key dates you need to have circled on your calendar if you're involved or watching this?
Absolutely. Dates are critical. So we had the board approval on July 15th, but the really crucial one is the record date. That's set for Thursday, July 24th, 2025.
The record date. Why is that specific date so important? What happens then?
That's the cutoff.
Yeah.
Simple as that. If your name is on the company's shareholder register by the end of that day, July 24th, you are eligible. You get the rights entitlement.
And if you buy shares after that date?
Too late for this rights issue offer, you won't get the entitlement. Okay, so after the record date, the issue itself opens on Friday, August 1st. Then there's another important date, Wednesday, August 6th. That's the last day for treating rights entitlements.
Rights entitlements. Yeah. Right. Can you just quickly break down what those are and why that August 6th deadline matters?
Sure. REs are basically temporary securities. They represent the right to apply for the new shares. They're like temporary permission slips.
Okay.
And the key thing is they're tradable. If you're eligible, but you don't actually want to buy the new shares yourself, you can sell your REs on the stock exchange to someone who does want to apply.
So you can cash out the right itself.
Exactly. But you only have until August 6th to do that trading. After that, the REs become worthless if they haven't been used to apply for shares or sold. And finally, the whole issue closes on Monday, August 11th. Though, keep in mind, they can extend that closing date, potentially up to 30 days if needed.
Right. So, assuming you are eligible on the record date, how many new shares can you actually subscribe to? What's the ratio?
The ratio they've set is 10 new rights equity shares for every 41 existing equity shares you hold as of that record date, July 24th.
Okay, 10 for 41. So if you held, say, 410 shares.
You'd be entitled to apply for 100 new shares. It's all proportional. And just for detail, the face value, the nominal value of each share is 10 rupees.
Okay, we got the mechanics down. Now let's get to the really interesting part, the why. Why is Spandana Sphoorty doing this now? What's the underlying situation?
Well, this is where it gets serious. The information points to the company facing severe stress in asset quality. For a microfinance company, that's a major red flag.
Meaning their loans aren't being repaid as expected?
Exactly. A significant chunk of their loan book might be souring, which obviously leads to losses and hits their core business hard.
And do the numbers back this up? The recent financial performance?
Oh, absolutely. In the last fiscal year, FY25, they posted a net loss of 1,035 crore rupees. That's a huge loss.
Wow.
And their gross bad loan ratio, that's the percentage of loans unlikely to be repaid, jumped up to 5.63% of their total loan portfolio.
Wow, okay, so that ratio climbing is a clear sign of deteriorating loan quality.
Precisely. It shows that the health of their core lending business has significantly worsened.
So, tying it all together, this 400 crore raise, it's basically plugging holes.
You could say that. It connects directly back to those issues. The fundraising looks very much aimed at shoring up their balance sheet, absorbing these potential loan losses, maybe paying down some debt, and generally getting their financial house in order to meet regulatory capital requirements. It's about tackling these fundamental problems head on.
And when you issue new shares like this, it changes the total number of shares out there, right?
Yeah.
What's the impact on the share count?
Yeah, absolutely. So before this rights issue, Spandana had about 7.13 crore shares outstanding. If everyone subscribes fully.
Which the discount encourages.
Right. Then the total number of shares will increase to roughly 8.87 crore. So nearly 1.74 crore new shares are being added.
Which means dilution for existing shareholders who don't participate.
Exactly. Your slice of the pie gets smaller if you don't buy the new shares you're entitled to.
Okay, let's talk about the share price itself. You mentioned the last close was around 306 rupees. How has it been behaving recently, especially with all this financial stress in the background?
Well, the price was 306.30 rupees. But what's quite interesting, maybe even a bit surprising, is that in the week before this rights issue detail came out, the share price actually went up by 9%.
Up, despite the losses and bad loans.
Yeah. It highlights something you often see in markets. Sometimes the news of a company taking decisive action, like a capital raise, even if it's needed because of distress, can create a short-term positive reaction, maybe anticipation of stabilization or just broader market currents.
Interesting paradox. Before we get into the wider market view, any other small print or technical details people should know, like trading codes?
Just a couple of quick things. For trading the rights entitlements, the REITs we talked about, there's a specific ID code, an ISIN, I-572J 2011. You'd need that if you were trading them. And also, things like how they handle fractional entitlements, like if your holding entitles you to 10.5 shares, what happens to the half share, those details will be spelled out in the official document, the letter of offer.
Got it. Okay, so we have the facts. Now let's talk impact. What happens theoretically, mathematically, right after a rights issue? You hear about this thing called TRP.
Right, TRP, theoretical X rights price. It's fascinating, actually. It's the market's way of adjusting the share price on paper for the fact that new shares are coming in, and they're coming in cheaper.
Because the new cheap shares dilute the value of the old ones.
Essentially, yes. The overall value gets spread over more shares, some of which were bought at a discount. So the theoretical price is expected to drop once the stock starts trading X rights, meaning without the entitlement attached. Using the numbers we have, 306 market price, 230 issue price, 10 for 41 ratio, a quick calculation puts the TRA around 291 rupees.
So purely on paper, the price should dip to around 291.
That's the mathematical expectation, yes. An immediate downward adjustment purely based on the mechanics of the issue.
And beyond the price adjustment, we touched on dilution. Can you elaborate on how that impacts shareholders and maybe the company's stats?
Sure. There are two kinds of dilution here. First, share count dilution. Simply more shares outstanding over 1.7 crore more. This means, all else being equal, earnings per share or EPS will theoretically go down.
Because the same earnings are spread over more shares.
Exactly. Unless that new 400 crore starts generating profit very, very quickly to offset it. And second, there's ownership dilution. If you're an existing shareholder and you choose not to subscribe to your entitled shares, your percentage ownership of the company automatically decreases.
Okay, so that's the theoretical, somewhat negative immediate picture. But markets aren't just math equations. How does the real market tend to react, especially considering Spandana's specific troubled situation?
Yeah.
Are there potential positives the market might see?
You're absolutely right. It's much more nuanced. On the plus side, this capital is clearly needed for strengthening the balance sheet. Given the, severe asset quality stress, the massive loss last year, the high bad loans, Raising 400 crore is a concrete step.
A necessary step.
A necessary step to inject capital, maybe pay down debt, boost their capital adequacy ratio, which regulators watch closely. If the market sees this as the company grabbing the bull by the horns, proactively fixing its problems, that could be viewed very positively.
So a sign of responsible management, perhaps.
Potentially, yes. And also, remember the bigger plan, 750 crore in total equity this year. While this first 400 crore is likely for stability, if some of that total is earmarked for actual growth down the line, that sends a positive signal about the future.
Looking beyond just survival.
Exactly. Plus, if the rights issue is successful, especially getting fully subscribed when the company is known to be struggling, it shows confidence from existing shareholders, particularly large ones, that can boost wider market confidence. And, of course, the 25% discount itself helps ensure success, showing strong support.
Okay, so those are the potential upsides the market might focus on. But what about the flip side? What are the negative interpretations that could drag the sentiment down?
Well, there's definitely a negative angle. First, the dilution is real, mathematically reducing EPS short term, as we said. But second, and perhaps more importantly in this context, a rights issue can often be read as a signal of distress.
Like they had to do this.
Precisely, that maybe other options like borrowing more money weren't available or were too expensive. Given their known financial problems, the losses, the bad loans, this perception that they're doing it out of desperation could be quite strong.
And what about the company's valuation relative to its assets, its book value? Does that play in?
It does, and it's an important point here. The market price before the issue, around 306 rupees, was already below Spandana's reported book value per share, which was about 368 rupees.
Meaning the market already valued it less than its balance sheet suggested.
Right, likely reflecting those asset quality concerns. Now, they're issuing new shares at 230 rupees, which is even lower than the already discounted market price and significantly lower than the book value. This could reinforce the negative view, putting more downward pressure on how the market values the company's intrinsic worth, at least in the near term.
So putting it all together, the need for funds, the discount, the dilution, the potential signals,
Right.
what's the likely overall market view here?
Look, given the backdrop, the severe asset quality stress, that huge 1,035 crore loss, the climbing bad loan ratio, this rights issue is almost certainly going to be seen primarily as a necessary move to tackle financial distress. It's about survival and stabilization first.
And the immediate stock price reaction.
You'd expect initial negative pressure. As the stock goes ex rights, that mathematical adjustment, the TERP calculation, will kick in. Plus, the market knows more shares are entering circulation at a lower price. That discount, while good for subscribers, also subtly underlines the company's urgency.
So the real test comes later. The long-term view depends on what they do with the money.
Absolutely, 100%. The ultimate lasting impact of this rights issue boils down entirely to execution. How effectively does Spandana use this fresh capital? Can they genuinely clean up their loan book, improve asset quality, stem the losses, and get back to sustainable profitability?
If they manage that.
If they can demonstrate a clear turnaround in the coming quarters, reduce those bad loans significantly, post consistent profits, then, looking back, this rights issue will be seen as a critical, positive turning point. The stock could react very well in the medium to long run.
But if not?
If the asset quality problems linger, if the capital doesn't translate into better performance, then that initial negative market reaction could worsen. The dilution hangs heavy, and the distress signal narrative wins out. Basically, this rights issue buys them time and resources. It's a lifeline. Whether they use it to swim back to shore or just tread water for a bit longer, that's what the market will be watching very closely.
That really lays out the stakes. A fascinating look at how one financial instrument plays out against a complex company background. It shows just how many layers there are to these moves. Hopefully this gives you a much clearer picture of what's happening with Spandana Sphoorty.
Yeah, understanding these mechanics, rights issues, dilution, market signals, it really empowers you when you're looking at how companies fund themselves and manage tough times.
Definitely. Now, just a quick reminder, we're not SEBI-registered financial advisors. This discussion is for informational purposes only. If you're considering any investment decisions, please consult with a certified financial advisor. Join us next time for another deep dive, where we'll break down another key topic. Until then, keep learning and stay curious.